Welcome to the March quarterly update for the SGH High Conviction Fund. My name is Hamish Tadgell, Head of Australian Equities and Portfolio Manager for the fund. As a reminder, the High Conviction Fund is an actively managed portfolio of up to 25 to 30 stocks, which seeks to take a longer term view, investing in quality companies and seeking to exploit market inefficiencies with a strong focus on valuation. Today I'm joined by Mike Kordick.
Thanks, Hamish. Good to be here.
Well, it's certainly been an interesting start to the year, dominated by big macro policy swings on the back of Trump and his tariff announcements, the RBA commencing rate cutting cycle in February, and the domestic reporting season. We've also seen a lot of uncertainty, in markets. It's been very volatile. During the month, the ASX 300 accumulation index was down 3.3%, but better, than the S&P 500 was down close to 6%. Importantly, the fund outperformed during that period, returning about minus 1.9%, so about 1% ahead of the market. Mike, maybe you could just give us a bit more colour on how the portfolio performed during the quarter.
Thanks, Hamish. Certainly can. We were pleased how the portfolio performed through reporting season, outperforming the benchmark, and really no major surprises. Reporting season is always a good opportunity to verify our investment thesis, and we didn't make many changes to the portfolio. Where we saw some of our strong results in a number of our stocks, Generation Development, Amplitude Energy and Worley. Generation Developments is a financial platform provider that owns investment bonds business as well. The stock price rallied strongly with a better than expected update, had positive net flows or inflows supported by growth in its managed accounts business. And we continue to see this business is very scalable with structural growth in the managed account business and investment bonds. And we think this will be complemented with further accretive M&A. If we just touch on some of the energy providers, Amplitude Energy and Worley both contributed strongly after reporting good results and underlying results. Really highlighted the good operating momentum and free cash flow generation of these respective businesses. And that provided some relief from the macro uncertainty that we have at the moment around energy policy. And the energy policy uncertainty really is impacting some of their share prices previously. Amplitude, that uncertainty came through around the East Coast gas policy, and Worley around the potential changes to the Inflation Reduction Act funding and also the US LNG projects, where Worley has quite significant exposure. Perhaps now, Hamish, I can pass to you and you can provide some comments around what you thought happened through reporting period, any changes.
Yeah, look, I think, Mike, one of the key things that we saw through reporting season was in the REIT sector. We saw this starting to emerge last reporting season in August, but we're starting to see REITs, we think, some bottoming in the property market. We're seeing increasing transaction evidence, which has been very supportive for book values. And investors are seem to be coming back into the market, and they have been on holiday clearly the last few years. The other big thing I'd say about the REITs is that over the last few years, they've gone through somewhat of a process of upgrading their portfolios and getting rid of some of the non-core assets. So you've had this situation where most of the portfolios across the REIT sector have been an upgrade. They've got rid of underperforming assets, and we've seen a recalibration of the assets, which has meant we're starting to see better rental growth coming through. The one other thing I'd say is that the trend in office market is certainly, I think, improving. There's still some way to go, but as a consequence, I should say, we're still cautious around office, but we think the cycle is turning, and with that, we think the office is looking a lot more interesting. That said, we've got a preference still for retail at this point of the cycle. We recently took a position in Vicinity. Vicinity owns the Gandel shopping centre, and a number of other very, very high quality shopping centres, which are very hard to replicate and are really continuing to benefit from really a shortage of supply, so still getting very strong positive net rental growth. The other thing we've done is we've added Somerset to the portfolio. So it's New Zealand retirement. It's not per se a REIT, which you'd think about in the strictest sort of way, but it's very leveraged to the property market, and we see, and it's also got a strong business in New Zealand, and we see with the rate cuts, 175 basis points of rate cuts in New Zealand now, that the market is starting to turn, and we think that Somerset is very well leveraged to that.
Of the things that I thought was interesting through reporting season was the performance of banks. Obviously, they've had significant performance in the last calendar year. However, through the reporting season, they were a relative underperformer. Just wondering if you could maybe comment on the bank results, if there are any cracks, and I guess where your updated thinking is right now.
Yeah, it's a good point, Mike. And it certainly was a big focus through reporting season. I think we came into reporting season with banks, as you say, have had an incredibly strong year the last 12 months, and looking, I think, expensive on any sort of measure. They're trading sort of 4 standard deviations above their historical long-term average, or at least CBA has been. So during reporting season, we saw a number of trading updates, and we saw a bit of weakness in the results. And I think it caught the market more broadly by surprise, just the extent of that, particularly the Bendigo result and I guess the NAB result. So what did we see? We saw, I would describe as a few cracks starting to open up. Nothing that makes us think that there's an imminent downturn, but the numbers just aren't as crisp as what they've been reporting over the last little while. So we saw NAB in particular, its net interest margin come down. We saw bad and doubtful debts tick up a little bit. We saw mortgage deferrals. Particularly, they called out Victoria, which I think a lot of companies were calling out as being very soft through reporting season. So I think I would say, though, it's important to put this in context. The quarterly results can be a little bit noisy, but I think what we are seeing is that the cycle is probably turned or at least peaked. And from here, our view is it's probably hard to see how the banks continue to re-rate. And so we're more cautious. We actually have been selling some of the banks, and we are significantly underweight or materially underweight the banks at the moment. Got about 7% in the banks as we speak. And I think that it's an area which we continue to watch, and probably a funding area for us as we look for other opportunities at this point.
Thanks, Hamish.
Mike, perhaps I could ask you about Light & Wonder, which is a stock we added to the portfolio through reporting season.
Certainly, Hamish. Yeah, Light & Wonder we recently added to the portfolio. It's a global leader in electronic gaming machines and gaming content. The stock is not without issues. A current litigation case is raised by a competitor against it. However, we think the underlying fundamentals are solid, and it's had really strong game performance. It's the clear number 2 operator in the industry, and the top 2 operators are clearly ahead of the rest of the pack. The company has an experienced management team. The management team transformed Aristocrat into a global leader about a decade ago, and right now the company is really well positioned for growth. It's trading on less than 14 times, and you're getting a 30% growth rate over the next 12 months. And the EPS compound growth rate will be in the range of 20% for the next few years. So it's pretty attractive to us.
It's interesting, Mike. I mean, it's clearly a stock that fits our sort of fundamental process in terms of looking for quality companies, strong growth, and attractive valuation.
Yeah, correct.
As I highlighted at the outset, there's been a lot of uncertainty in markets and a lot of volatility driven by the macro. I guess that's creating opportunities, but maybe you could give us a bit more colour about how we're thinking about positioning in the current environment and some of the themes that are sort of running through the portfolio.
Yeah, good question. Certainly at the moment the market is very unpredictable and warrants some caution. Yeah, we've increased the defensiveness in our portfolio. That said, we believe there's some good opportunities. Companies have strong prospects, good growth rates and attractive valuations, as you mentioned. And some of the key themes I'll touch on will be critical infrastructure, essential services, and the gold sector. Just from a critical infrastructure, companies we like are Chorus and Infratil, with monopoly or regulated assets that have large barriers to entry. Chorus, for instance, is a wholesale internet provider to the majority of New Zealanders with limited competition. It benefits from increase in data demand, increase in market penetration. It's also inflation hedge with CPI-linked pricing. It's got significant growth in free cash flow as it moves from that construction phase into the operating phase. And we've seen a growth in dividends as well. And interestingly, last August, they increased their dividend by 20%. Having said that, the stock's actually trading about $1 or 10 to 15% lower than those levels at the time, and it's currently yielding a 7% dividend yield, which we think is attractive. Just on the Infratil front, it owns a number of defensive and infrastructure-like assets across digital, renewables, and the healthcare sector. The key assets are the Canberra data centres, Long Roads, and One New Zealand, previously Vodafone, so telco. So I think this is another company expected to provide defensiveness as well as earnings growth through these times. Essential services companies we see as defensive revenues generated from their products and services they're used on a daily basis. For example, Cleanaway, and you mentioned Somerset, so maybe I'll just dive into Cleanaway. Cleanaway is a market-leading waste management company. It dominates the industry. It's got strategic infrastructure-like assets, and that's its national footprint of landfills and transfer stations. Also, we see it with favourable regulatory and industry tailwinds. We think the stock's attractively priced. It's got a PEG ratio of 1 times. So we're seeing a compound earnings growth rate in the low 20s and its PE around that same level. So we think that's going to go well going forward into the next couple of years. And finally, the gold sector. Look, we think gold's a valuable diversifier, providing hedge against geopolitical risk, inflation, and potential US dollar weakness. In this sector, we own Genesis Minerals and Northern Star. So Genesis Minerals is a mid-cap gold miner consolidated in the Leonora gold mining region with a very capable management team that we know well from their time at Saracen. Genesis is clearly benefiting from a strong gold price, as is Northern Star. And in addition, the management are targeting really strong production growth, doubling over the next couple of years to 300,000 ounces or in excess of that amount, as well as reducing the production costs. Northern Star, large cap gold miner, tier 1 assets, substantial gold reserves and low production costs. So I think that's a good summary of the gold sector as well.
Thanks, Mike. Look, I think that's been great insight into the portfolio, and I think really highlights the different sources of opportunity that we currently see. The idea in building the portfolio is clearly to get diversification across the life cycle so that we've got different drivers from different stocks helping deliver performance. And with that, really trying to provide downside protection. And in uncertain times, like it is at the moment, that's really, really important. And I think the portfolio has clearly had a very strong track record of doing that in the past, outperforming about 90% of the time in down markets. So Mike, thank you very much for joining me today and the update.
Thanks, Hamish.
In closing, I'd just like to remind investors that the High Conviction Fund is a concentrated portfolio of 25 to 30 stocks. And we think it is a strategy that is actually ripe for the times. You know, in a high level of uncertainty that we're seeing in markets at the moment, the focus on quality stocks, the focus on valuation, means that it builds resilience into the portfolio. And as we've discussed, we see many good opportunities where we think that there is value, latent value, which we're looking to capitalise over the next few years and beyond. So thank you for joining us, and we look forward to the next update in June.